Today's topic is market data analysis, probability and distribution of assets price, modeling, risk factor. 16, 16 students are there. Again, good morning to all. Market data analysis. Meaning, market data analysis involves the connections, processings, and interpretation of financial market data to measure risk and volatility. Market data includes price, returns, interest rates, exchange rate, and trading volume. Types of market data: price data, equity prices, bonds, prices, commodity prices. Return data, daily, weekly, monthly returns. Rate data, interest rates, FX rates, volume and liquidity data. Traded volume, bid ask spreads. Market risk. Statoil had established an enterprise-wide risk management (ERM) program for managing market risk. The Corporate Risk Committee (CRC) met on a regular basis to review the existing policies and implementation of guidelines. Statoil used a top-down approach to risk management, which highlighted the most important risk and then used a sophisticated risk optimization model to manage these risks. Statoil believed it had a comprehensive model which encompasses most significant risks and took into account correlation, different tax regimes, capital allocations at various levels, and value at risk at different levels with the goal of optimizing risk exposure and return. The model also utilized the Sharpe ratios, which provided a risk adjusted returns measures in the context of a specific risk taken. The Corporate Risk Committee, headed by the Chief Financial Officer and which included representative from the principal business segments, was responsible for defining and implementing Statoil's strategies, market risk policy. The CRC, means the Corporate Risk Committee, met monthly to determine risk management strategies, including hedging and trading strategies and valuations methodologies. Statoil divided risk management into insurable risks, which were managed by a captive insurance company, tactical risks, which were short-term trading risks based on underlying exposures and which were managed by line management, and strategic risks, which were long-term fundamental risks and were monitored by the CRC. To address tactical and strategic risks, Statoil had developed policies aimed at managing the volatility inherent in some of these natural business exposures. In accordance with these policies, it entered into various transactions using derivatives instrumentations. Because Statoil operated in the international oil and gas markets and had significant financing requirement, it was exposed to fluctuations in underlying interest rates, foreign exchange rates, and commodity such as oil, natural gas, and redefined petroleum products prices. Statoil used derivatives to reduce the risk in overall earnings and cash flows. Total exposure was managed at portfolio level in accordance with the strategic and mandates issued by the ERM program and monitored by the CRC. Statoil mainly employed interest rate and currency swap agreements to manage interest rate and currency exposure. Statoil used swaps, options, futures, and forwards to manage its exposure to change in the value of future cash flows from future purchases and sales of crude oil and redefined oil products. The term of the oil and redefined oil products derivatives was usually less than 1 year. Natural gas and electricity swaps options, forwards, and futures were likewise utilized to manage statal exposures to change in the value of future sales of natural gas and electricity. These derivatives usually had terms of approximately 3 years or less. Most of the derivatives transactions were made in the over the counter OTC market. In India, the business of crude oil is on high level. Even we are also consuming this crude oil because the manufacturers always use this crude oil to mix in to make the oil from soybeans and other. This fact we should have no strategic market risks. Strategic market risks were reviewed by the CRC to reduce the likelihood of experiencing financial distress and to support the group's ability to finance future growth even in downturns. Statoil had put in place various policies and procedures to reduce overall exposure to strategic risk. For example, Statoil Statoil's multi-currency liability management model sought to optimize the debt portfolio based on expected future corporate cash flow and thereby serves as a significant strategic risk management tool. In addition, the downside protection program for crude oil price was intended to ensure that the business would return robust even in the case of a drop in the price of crude oil. Tactical market risk, commodity price risk. Commodity price risk constituted Statoil's most important tactical risk. A substantial or extended decline in oil or natural gas prices would have a material adverse impact on Statoil. Historically, prices for oil and natural gas had fluctuated widely due to many factors that are global and regional economic and political development in resources producing regions, particularly in the Middle East. Global and regional supply and demand. The ability of the organizations of petroleum exporting countries and other producing nations to influence global production level and prices. Prices of alternative fuels, which affected realized price under Statoil's long-term gas sales contracts. Norwegian and foreign governmental regulations and actions. Global economic conditions, price and availability of new technology, weather conditions, declines in oil and natural gas prices adversely affected Statoil's business. lower oil and natural gas prices might also reduce the amount of oil and natural gas that Statoil produced economically, or reduce the economic viability of projects planned or under development. To minimize commodity price risk, Statoil and derivatives, which consist of future options over the custom OTC, forward contracts, market swaps, and contracts for differences related to crude oil, petroleum products, natural gas, and electricity. Derivatives associated with crude oil and petroleum products were traded mainly on the International Petroleum Exchange IPE in London. The New York Mercantile Exchange NYMEX, that is New York Mercantile Exchange, in the OTC, Brent market, and in crude and refined products, swaps, market derivatives associated with natural gas and electricity were mainly OTC, physically forward and options, not pull forwards, as well as future traded on the IPE. The maturity of crude oil and refined products derivatives was usually less than 1 year, while that of natural gas forwards was usually 3 years or less. The net fair market values of FAS 133 derivatives associated with long-term natural gas contracts, that is 10 years or more, was NOK 91 million and negative NOK 145 million as of December 31st, 2002 and 2001, respectively. Also included in the fair market values and basis for sensitivity figures were immaterially deprived positions held for speculative purposes. Statoil estimated risk sensitivity by assuming a hypothetical across the broad 10% adverse change in all commodity prices, regardless of the term or historical relationship between the contractual price of the instrument and the underlying commodity prices. In the event of an actual 10% change in all underlying prices, the change in the fair value of the derivative portfolio would typically be different from that shown due to expected correlations between risk categories. In addition, there would be expected offsetting effects from changes in the fair value of corresponding physical positions, contracts, and anticipated transactions, which were not required to be recorded at market. Change in certain underlying commodity prices in relation to other prices would typically result in other sensitivities. Natural gas sensitivities might, for instance, be adversely affected by certain relative commodity price changes due to pricing elements in long-term physical delivery contract and assumptions used in arriving at the fair market value of FAS 133 derivatives related to long-term contract. Equity price risk. Equity instruments were exposed to price risk. The fair value of these instruments was based on quoted market prices. Risk was estimated as the potential loss in fair values resulting from a hypothetical 10% adverse change in quoted market prices. Actual results might vary due to derivations from assumptions in utilized and risk correlations. Foreign exchange risk. Statoil's cash flows were largely denominated in currencies other than NOK cash receipts in connection with oil and gas sales were mainly in foreign currencies and cash disbursements were to a large extent in NOK. Accordingly, Statoil was exposed to movements in US dollars, European euro, Danish kroner, Swedish kroner, and UK pounds sterling. Statoil used forward foreign exchange contracts primarily to manage existing receivables and payables, including deposits and borrowing denominated in foreign currencies. Currencies options purchased in the OTC market for a premium provided Statoil with a right to buy or sell an agreed amount of currency at a specified exchange rate at the end of a specific period. Steps in market data analysis, that is data collections, stock exchanges, central bank and financial databases, data cleaning, removal or missing values and outlines, return calculations. Calculations are given, descriptive statistics, mean variance, standard deviations, skewness, kurtosis, trend and volatility analysis, moving average, rolling volatility. Importance of market data importance that are help identify risk patterns, measure historical volatility, supports VAR, value at risk, and stress testing, improves portfolio decision making. Second is probability and distributions of asset prices. Role of probability in risk measurement. Probability theory helps quantify likelihood of losses, expected returns, tail risk, and extreme events. Risk-based bias. Consider some of the risks that you face during a semester as a student. The obvious risks are that you could become ill or injured. You could have an automobile accident. Your residence could burn down. Your vehicle could be stolen, and so on. A common aspect of this risk is that insurance contract generally exist to keep help you manage the risk. In addition, you could reduce your exposure to the risky by taking additional precautions or by avoiding the activities that use risk to the rise. Considered some other risk that you face. You could buy food that is contaminated. You could purchase a product that causes an accident, or your bank could fail. A common aspect of this risk is that some type of government or social policy exists to help you deal with the consequences. Notice that the existence of these social policies lessens the extent to which you will deal with them privately, either by purchasing insurance or by taking additional precautions. You are also exposed to many other risks where neither insurance contract nor public programs exist to help you. For example, A sibling could die, causing you emotional distress. Your teacher could give a very difficult exam, or you could forget a fundamental concept. So that in either case, you bomb the exam, causing your grade point average to suffer. Ultimately, your best friend could decide to avoid you forever. Generally, the only way to deal with these risks is to engage in some losses control activity. For example, studying more often. That will reduce either the chance of the loss occurring or the size of the loss if it does occur. I have suggested this example only for you that most of the students not study day by day or regularly. They do the study at the time of only exams. Okay, so there may be chaos or he may be confused which study should have to give priority. So you should have to do your own schedule of daily routine life. Okay, you have to set this schedule to study your routine MBA course. For you can give timing for your exercise, your job, your daily routine life. Okay, and after that you have to give timing for study. The pervasiveness of risk apparent, the optimal response to risk from a business's or an individual perspective is one of the central issues addressed in the book. In addition, we will provide answer to other interesting and important questions such as why do insurance contracts exist for some but not all risks? Why do we have government programs to lessen some types of risk? What are the effects of these programs on individual behavior? Answer to these questions and many other require a framework in which to analyze risky situations. The framework we use is in based on the same fundamental concept from probability and statistics, which are presented in the subsequent sections of these sessions. Saving and thus the risk of not having sufficient assets during retirement to fund expenses depends on how the assets are invested. The choice of assets, for example, between stocks, bonds, and real estates, is an important risk management decision for all individuals and households. Even after someone has retired with substantial assets, the person faces the risk of living so long all savings are depleted prior to death. This longevity risk can be managed using annuities, including governmental mandated annuities, such as those provided in the US social security systems. There are so many provisions from governments to secure your retirement life. You can take different types of insurance for your retirement life, or there are different types of policies. You can pay your premiums monthly, quarterly, half yearly, and yearly. Basic concept from probability and statistics. Risk assessment and measurement requires a basic understanding of several concepts from probability and statistics. We review this concept in this section. These concepts also are needed to understand much of the material in subsequent sessions. Random variable and probability distributions. A random variable is a variable whose outcome is uncertain. For example, suppose a coin is to be flipped and the variable x is defined to the to be equal to $1. If heads appears and $1, if tails appears, then prior to the coin flip, the value of x is unknown. That is, x is random variable. Once the coin has been flipped and the outcome revealed, the uncertainty about x is resolved because the value of x is then known. We flip coin at the time of playing games also. Cricket, toss. What what will be the outcome? Head or tail only. Okay. Information about a random variable is summarized by the random variable probability distribution. In particular, a probability distribution identifies all the possible outcomes for the random variables and the probability of the outcome. For the coin flipping example, it gives the probability distribution for x. In addition to describing a probability distribution by listening the outcome and probabilities, we also can describe probabilities distributions graphically. The probability distribution for the coin flipping example, on the horizontal axis, we graph the possible outcome. On the vertical axis, we graph the probability of the particular outcome. These are only two possible outcomes. In this very simple example, $1 and $1, and then probability of each is 0.5. When discussing random variables, we use the term actual or observed outcome, or sometimes realized outcome, to refer to the outcome observed, realized in a particular cause, as opposed to the possible outcome and could have occurred in the coin flipping example. Once the coin has been tossed, we can observe the actual outcome, which either must be $1 or $1. As emphasized in the first two sessions, risk management decisions need to be made prior to knowing what the actual realized outcome of key variables will be. Managers to do not know beforehand which outcome of the random variable affecting the firm's profits will occur. Nevertheless, they must make decisions. Once the outcomes are observed, it usually is easy to say what would have been the best decision. However, we cannot evaluate decisions from this perspective, which is why probability distributions are so important. Probability distributions tell us all of the possible outcomes and the probability of those outcomes. Information about probability distribution is needed to make good risk management decisions. As a second example of a probability distribution, we can approximate the probability distribution for the dollar amount of damage to your car during the company year. For simplicity, our approximation will assume only five possible levels of damages. that is $0, $500, $1,000, $5,000, and $10,000. The probability of each of these outcomes are listed in these sessions. The most likely outcome in zero damages, and the least likely outcome is that damages equal $10,000. Note that the sum of the probabilities equals 1. This must always be the case. An alternative way of describing the probabilities distribution is provided by this session, where the height of each dotted lines gives the probability of each possible outcome. As a final example, considered an automaker. Two of the many reasons why the automaker's profit are uncertain are still price changes and labor conditions. In the language just introduced, the automaker's profits are the random variable. There are numerous possible outcomes for the automaker's profits. For example, steel prices could increase so much that price profits could be negative. On the other hand, favorable outcomes for steel prices and the economy could cause very high profits. Actually, the manufacturer never accept the loss. He always manage the rates, although they are ups and down, means fluctuations are there in rates. What is the probability distribution for the automaker's profits? Recall that a probability distribution identifies all of the possible outcomes and associates a probability with each outcome. The coin flipping example had only two possible outcomes, and so listing the probabilities was simple. In the automaker example, however, we could spend hours listening all the possible outcomes and for profit and still not be finished. Due to the large number of possible outcomes in this situation, it is useful to assume that the possible outcomes can be any number between two extremes, that are the minimum possible outcome and the maximum possible outcome, and that the probability of the outcome between the extreme is represented by a specific mathematical function. For example, assume that profit for the automaker could be any number between $20 million and $50 million. Just as with the earlier graphs, we can identify the possible outcomes for profits between the amounts on the horizontal axis of figure, which illustrate the probability distribution for the automaker's profits. Analogous to the earliest graphs, the vertical axis will measure the probability of the possible outcomes. The possibilities of the outcome are illustrated in figure by a bell-shaped curve, which might appear familiar to you. Recall that the sum of the probabilities of all the possible outcome must equal 1. Some outcome must occur. In the coin flipping example and the automobile damage example, this property is easy to verify because the number of possible outcomes is small, stating that the probability sum to 1 in this example is equivalent to stating that the heights of the dotted lines in figure 3.1 and 3.2 sum to 1. This is useful observation because it helps to illustrate the analogous property in the automaker example, where any outcome between $20 million and $50 million is possible. You can think of the curve in figure 3.3 as a curve that connects the top of many thousands of bars that have very small widths, and the sum of the heights of all these bars is equivalent to the area under the curve. Thus, stating that the probability must sum to 1 is equivalent to stating that the area under the curve must equal 1. Since the area under the curve in figure equals 1, we can graphically identify the probability that profits are within a certain interval. For example, the probability that profits are greater than $40 million is the area under the curve to the right of $40 million. The probability that profits are less than $0 is under the curve to the left of $0. The probability that profits are between $10 and $30 million is the area under the curve between $10 and $30 million. Thus, the bell-shaped curve in figure tells us that for the automaker, there is a relatively high probability that profits will be between $10 and $30 million. In contrast, while very low profits and very high profits are possible, they do not have a high probability of happening. Concept checks. 1. What information is given by probability distributions? What are the two ways of describing a probability distribution? Earthquakes are rare, but the property damage can be very large when they occur. Illustrate these features by drawing a probability distribution for property losses due to an earthquake for a business that has property valued at $50 million. Identify on your graph the probability that losses will exceed $30 million. Characteristics of probability distributions. In many applications, it is necessary to compare probability distributions of different random variables. Indeed, most of the material in this session is concerned with how decisions, for example, whether to purchase insurance, change probability distributions, understanding how decision affects probability distributions will lead to better decisions. The problem is that most probability distributions have many different outcomes and are difficult to compare. It is therefore common to compare certain key characteristics of probability distributions: the expected value, variance, or standard deviations, skewness, and correlations. Expected value. The expected value of probability distributions provides information about where the outcome tends to occur or average. For example, if the expected value of the automaker's profit is $10 million, then profit should average about $10 million. Thus, a distribution with a higher expected value will tend to have a higher outcome on average. To calculate the expected value, you multiply each possible outcome by its probability and then add up the results. In the coin flipping example, there are two possible outcomes for X, either $10 or $-1. The Probability of each outcome is zero point 0.5. Therefore, the expected value of x is $0. If one were to play the coin flipping game many times, the average outcome would be approximately $0. This does not imply that the actual value of x on any angle toss will be $0 indeed. The actual outcome for one toss is never $0. To define expected value in general terms, let the possible outcome of the random variable x is denoted by x1, x2, x3 and x up to m. This corresponds to minus $1 and $1 in the coin flipping example. And let the probability of respective outcome be noted by P1, P2, P3 and up to Pm. This corresponds to the zero point 0.5 used in the coin flipping example. If we examine a probability distribution graphically, we often can learn something about the expected value of the distribution. Two probability distributions, since the distribution for A is shifted to the right compared with B, distribution A has a higher expected value than distribution B. When distributions are symmetric in figure, identifying the expected value is relatively easy. It is the midpoint in the range of possible outcome. When the probability distributions are not symmetric, identify the expected value by examining a diagram sometimes can be difficult. Nevertheless, you often can compare the expected values of different distributions visually. Consider, for example, the two distributions illustrated in figure. Distribution C has a higher expected value than distribution D. Intuitively, the high outcome are more likely with the distribution C than with D, and the low outcomes are less likely with C than with D. Many risk management decisions depends on the probability distribution of losses that can arise from lawsuits, workers injured, damage to property, and the like. When a probability distribution is for possible losses that can occur, the distribution is called a loss distribution. The expected value of the distribution is called the expected loss. Concept check 3. What is the expected value of damage for distribution listed in figure? Variance and standard deviations. The variance of a probability distribution provides information about the likelihood and magnitude by which a particular outcome from the distribution will differ from the expected value. In other words, variance measures the possible variations in outcome around the expected value. If a distribution has low variance, then the actual outcome is likely to be close to the expected value. Conversely, if the distribution has high variance, then it is more likely that the actual realized outcome from the distribution will be far from the expected value. A high variance, therefore, implies that outcomes are difficult to predict. For this reason, variance is a commonly used measure of risk. In some instances, however, it is more convenient to work with the square root of the variance, which is known as the standard deviation. To illustrate variance and standard deviations, consider three possible probability distributions for accidents losses. Each distribution has three possible outcomes, but the outcomes and the probabilities differ. The three probability distributions are shown in following. For each of the loss distributions in table, the expected value $500, you should verify this by yourself. But the variance of the three distribution differ. Loss distribution 2 has a large variance than distribution 1 because the extreme outcome for distribution 2 are further from the expected value than they are for distribution 1. Distribution 3 has a large variance than distribution 2 because even though the outcomes are the same for distribution 2 and 3, the extreme outcomes are more likely with distribution 3 than with distribution 2. That is, the probability of having a loss from the expected value $500 is greater with distribution 3 than with distribution 2. The comparison of distribution 2 and 3 illustrate that the variance depends not only on the dispersion of the possible outcome but also on the probability of the possible outcome. The mathematical definitions of variance and standard deviation shows precisely how the probabilities of the different outcomes and the deviations of each outcome from the expected value affected these measures of risk. Common probability distribution used in finance. Normal distributions features symmetrical bell-shaped curve, mean, median, and mode used for modeling assets returns. Simplified assumptions, limitations fails to capture fat tails, underestimate extreme losses. Log normal distributions used for asset prices, not returns. Prices cannot be negative. Returns are normally distributed. Fat tail distributions, example, students distributions, Levy distributions. Levy distributions after features higher probability of extreme events, better representations of financial market behavior. Skewness and kurtosis. Skewness, asymmetry in return distributions. Kurtosis, fat tails and thickness. Financial returns often show negative skewness and high kurtosis. Modeling asset price behavior. Random walk hypothesis. Prices follow a random path. Past prices cannot predict future prices. Geometric Brownian model motions GPN used in option price models. Black-Scholes. Black-Scholes. What is Black-Scholes? The Black-Scholes model, also known as the Black-Scholes Merton BSM model, is a mathematical model for pricing an option contract. In particular, the model estimates the variation over time of financial instruments. It assumes these instruments, such as stocks or futures, will have a log normal distributions of prices. Using these assumptions, and factoring in other important variables, the equation derives the price of call options. The basic of a Black-Scholes model. The model assumes the price of heavily traded assets follows a geometric Brownian motions with constant drift and volatility. When applied to stock options, the model incorporates the constant price variation of the stock, the time value of money, the option strikes price, and the time to the option's expiry, also called Black-Scholes Merton. It was the first widely used model for option pricing. It's used to calculate the theoretical value of options using current stock prices, expected dividends, the option strike price, expected interest rate, time to expirations, and expected volatility. The formula developed by three economists, Fisher Black, Myron Scholes, and Robert Merton, is perhaps the world's most well-known option pricing model. The initial equation was introduced in Black and Scholes' 1973 paper. The pricing of options and corporate liabilities purchased in the Journal of Political Economy. Black passed away 2 years before Scholes and Merton were awarded the 1997 Nobel Prize in Economics for their work in finding new methods to determine the value of derivatives. The Nobel Prize is not given posthumously. However, the Nobel Committee acknowledged the Black's roles in the Black-Scholes model. Modeling risk factors, meaning risk factors modeling identifies key variables that drive changes in assets prices and portfolio values. Common financial risk factors that are interest rate risk factor, exchange risk rate risk factor, equity price risk factor, commodity risk price risk factor, and credit risk factor. Single factor and multi-factor model. Single factor model, CAPM, means Capital Assets Price Model, is a classic example. Simple but limited. Multi-factor models, example, arbitrage pricing theory, APT. French three-factor models includes market factors, size factor, value factor. Advantages, better explanations of return behavior, improved risk management, correlations, and covariance in risk modeling. Correlation measure a relationship between assets. Covariance is used in portfolio risk calculation. Diversification benefit depend on correlation structure. 7. Stress testing and scenario analysis. Stress test assess extreme conditions. Scenario analysis examines specific events used by banks, financial institutions, regulations. Importance of modeling with factors supports VR computations, help measure portfolio risk, improves hedging strategies, enhance regulatory compliance. Limitations of risk modeling, model risk, data limitations, assumption failures during arises. And conclusion, market data analysis, probability distributions, and risk factors modeling form the foundation of modern risk and volatility measurement. While models simplify reality, their careful applications helps organizations understand, measure, and manage financial risk effectiveness. Thank you. Today's session is over.